good afternoon, everyone. Thank you for taking your time on this weekday to join us for this exclusive webinar on taxation. I am Kirtana, your host for today's session. Our speaker for the day is Mr. Karthik Gala. Karthik is the head of research at Multipl with a rank holder chartered accountant. He has a prior work experience with Goldman Sachs, Lloyd George Advisory, and Bank of Montreal. Post registration, we have received a lot of queries regarding the deductions available, tax labs, and the forms to be used. We tried our best to compile all of them. If you have any queries, doubts, feel free to ask by raise of hand or dropping your questions on the comment box. At the end of this webinar, we will be sharing you a feedback link. You can post your questions there as Now, before starting, let's take a quick poll. Uh, the poll will be on your screen. The question is, which tax regime are you currently opting for? Is it the old tax regime, new, or you are yet to decide on that? Let's wait for 2 more minutes for everybody to vote. Okay, so I guess everybody's vote are in. So the result is okay. So we see the maximum people have yet to decide on which regime to choose. This is the right webinar you're attending. Let's find out which tax regime is how to choose your tax regime and which tax regime is good for you. And now, to formally start the event, I would like Karthik to take the dice.
Yeah, thanks, Kirtana. And once again, good afternoon, and thank you for taking time out to attend this webinar. Uh, so we had around, we had several more registrations, but I'm seeing only just 7 of you. But nonetheless, we'll go ahead with this. So thanks for your time. I have started the presentation sharing, so I hope it's visible to all of you. If not, please just point it out here on the chat. Yeah. So as the topic is and the season is for tax filing, we thought this will be an apt time to come out with this informative webinar. So before we proceed, just a disclaimer that we are not tax practitioners, or we are not practicing chartered accountants who have expertise in every aspect of taxation. So this is just an informational session, more from the point of view of investments, so taxation related to investments. And along with that, as Kirtana highlighted, that from the queries, we have tried to compile some information about what kind of forms you should be using, what are the deductions available, new tax regime, old tax regime, so on and so forth. So this will basically, Kirtana, can you just mute? Yeah, thanks. Yeah. So this will basically be the agenda. We'll cover the forms which are available. What are the tax slabs? We'll compare both the regimes. What are the deductions under both the regimes, and a checklist for you guys. So there were quite a few queries on how we should go about filling the form, or which form would should I fill for filing my income tax returns. So see, how you should think about the form is basically what I mean, it is depending on certain aspects. First and foremost will be your income. So what is the level of income? That will be one determinant for selecting the type of form. Second will be holding certain assets, or holding having certain kinds of income. So for example, if you're having income from business or profession, then a particular form is applicable. If you are having only salary income or income from house property, then a different kind of form is applicable. So on these kind of determinants, the forms are dependent. So we'll take one by one. So first is ITR Form 1, which is the simplest one. It is also called Sahaj. So if you are a salaried employee, you don't have any other income apart from your salary and from a single house property, then this is the form which we should be choosing. So if you don't have income from capital gains, income from any business or profession, then this is the choice of form. Also to keep in mind is you should not be a director in any company, and you should not be holding shares of any unlisted company. In that scenario, ITR form 1 is the one for you. Moving on to ITR Form 2. This is for somebody having annual income more than 50 lakhs. House properties, two or more. So if you are owning two or more house properties and you are earning income from those, then this is the income for you. And also if you're having company directorship. So again, the point to note here is that these things are not all together. In the sense, if you are having annual income of more than 50 lakhs and company directorship, then also this form will be applicable to you. If you are having annual income of more than 50 lakhs and two or more house properties but no company directorship, then also this form will be applicable to you. Now, people who have income from business or profession, for them, ITR Form 3 becomes applicable. So, whether you're a professional, so there have been cases, questions, if I'm a professional, then what is the form which I should be choosing? So, in that scenario, it is form number 3, which has to be chosen, irrespective of the size of the business, even if it's a small business or a larger business, or you have income from partnership firm, whether you are active partner or a dormant partner, irrespective of that fact, ITR form 3 will be the one in which you have to choose if you have profit or gains from business or profession. So ITR 4 is predominantly for those who choose presumptive income or presumptive taxation. So under Section 44 of the Income Tax Act, there is some benefit or advantage which the authority or the government has provided to professionals or certain kind of businesses. So if you are in a profession of, say, architecture, or if you are in a business of plying goods or carriage of goods, such kind of businesses, then under Section 44 and some related sections, there is a simpler method to file your tax returns. You need not maintain. So if you abide by these sections, then you need not maintain books of accounts, and your calculation of the taxable income becomes very, very simpler. It is 8% or 6%, depending on certain criteria of the total revenue. Just that 8% or 6% number becomes your taxable income. So in that scenario, you need to file, if you're taking the benefit of presumptive taxation, then you need to file ITR 4. And lastly here, ITR number 5 is applicable to or artificial persons. So it can be a firm, it can be an LLP, body of individuals, association of persons. In that scenario, ITR 5 is the form which you need to file. Kirtana, you would like to run the second poll?
Yes, Karthik. The polls are already on the screen. Let's wait for 2 more minutes for everybody to vote. Okay. So the answer, like maximum votes have come for lower tax rates. Yes, Karthik.
Yeah. So for the first poll, the maximum voting was for not decided which tax regime to be chosen, and here the preference is lower taxes. Obviously, who doesn't like to pay lesser taxes, right? So let's touch upon both these points in the next few slides. So here, what you are seeing right now is a comparison between the old tax or the slabs and the rates of each slab in the old regime, which is the top table, and in the new regime from this year onwards, FY 2024. right? This was slightly for the slabs, and the rates in the new regime was slightly different for FY23, but this is what it stands as of now. So, the point on lower tax rate, if you see the advantage in new regime is that the taxation at the rate of 30% starts only after taxable income of 15 lakhs. What happens is, in the new regime, in the old regime, the tax rate of 30% starts hitting you as soon as your income crosses, taxable income crosses limit of 10 lakhs, right? The last row in the top table. Whereas in the new regime, from 10 to 12 lakh of taxable income, you are paying rate of 15%. From 12 to 15, you are paying a tax rate of 20%. And above 15, you are paying a tax rate of 30%. So in that sense, there is advantage that the hit or the impact of the 30%, the margin, the maximum rate starts hitting you only after a slab of 15 lakhs. Here in this table, continuing with the new tax regime, what you can see is we have put down different levels of income, and what is the amount of deductions which is available to you or you are already taking. You can compare that, and if the amount of deductions which you are taking or which you have to set off your income, if it is equal to or more than the amounts which are highlighted in yellow in the last column, then you should opt for the old regime. So for example, let's take the income of 20 lakhs. If somebody is earning an income of 20 lakhs and she's having deductions of 4,25,000 rupees with her, then she's neutral. The tax liability in the old regime or the new regime will be similar. I'll show you in the next slide itself. So here we have taken exactly the same example. So here an assessee is having income of 20 lakhs, and under the old regime, if she has deductions of 4,25,000 rupees, then her tax liability will come at 2,85,000 rupees. Whereas in the new regime, even without any deductions, just having the standard deduction of 50,000 rupees, the tax liability comes same, 2,85,000 rupees. So if I just move back to the previous slide, this is like a ready reckoner which you can think of. So if your income is say 20 lakhs, you don't have deductions of 4,25,000, or you have deductions which is less than 24,25,000, then you should straight away opt for the new regime. That's it. So when we share either the presentation or we'll share across at least one of these slides, there are some in links also which take you to the income tax portal. They have these calculators where you can also input the data and compare for yourself as to which regime, old or new, would be beneficial for you in terms of your tax liability. Yeah, this will, I think, be our last poll, Kirtana.
Yes, Karthik, the polls are on the screen.
Yeah.
How familiar are you with the deductions and exemptions available under the old tax regime? I've got 5 votes. We'll just wait for a minute more. Okay. So people are somewhat familiar with the old deductions and the old tax regimes. Yes, Kat.
Yeah, thanks. Cool. So next couple of slides, I'll talk about the deductions under the old tax regime. So these, on the first slide, these five, six are most familiar ones. Uh, a lot of us would be availing most or at least several of these deductions, right? So first and foremost is ATC, the most popular. So your public provident fund, your equity linked savings scheme, life insurance premium, or a tuition fee of children, all those things, and repayment of principal amount of your home loan, and several others fall into this. There is a cap on this up to 1,50,000, which has not been revised for quite some time. Next is 80 one b, which is additional contribution to new pension scheme. This 50,000 rupees cap is over and above the amount of 1,50,000. So in that sense, this is a beneficial section because it increases the amount of deduction which is available to you. The next one, 80D, is of an expense nature, in the sense you are incurring expenditure for buying a mediclaim policy, either for yourself or your for family or for your parents. And you're depending on the age of yourself and your parents, the amount of deduction can vary from 25,000 rupees till 1 lakh rupees. The next is under section 80 TTA1, which is for anybody under the age of 60. You can avail a deduction of up to 10,000 rupees against the income which you are earning as interest from your savings bank account. So if the income is less than 10,000 rupees, say 5,000 rupees, then your deduction will be limited to 5,000 rupees. You won't get 10,000 rupees. The maximum is 10,000 rupees cap. 80E is interest on education loan. Here there is no cap, but it is there is no cap in terms of the amount which is to be which can be claimed as a deduction. However, there is a cap in terms of the time period which the benefit can be availed of. So once the year in which you start paying the interest for the whole for the education loan, after that, for 7 succeeding assessment years, you can claim the advantage or benefit of this section, not beyond that. And 80G is donation. So donation is a pretty wide section, in the sense there are qualifying institutions to which if you donate, you can claim deduction against that. And then again, it depends whether you can get 50% of the amount as a deduction or 100% of the amount you've donated as a deduction. So these five six sections are pretty widely known, pretty widely used also. If not all, at least three four of them would be widely used by all those who are opting for the old tax regime. The next set, again, this is part of the old tax regime itself, are those deductions which not necessarily that would be widely you would be widely used. So 80DD, DDB, and 80U are related to medical conditions and expenditure incurred towards medical treatment or medical conditions, either for self or for dependents. So based on there are diseases or the treatments which are mentioned in the Income Tax Act, and if you are incurring the expenditure for any of those, so wherever they fall, whether in DD or DDB or U, and basis whatever is the severity or the extent of the disability, 40%, 80%, and in certain cases age, based on all these criteria, you can get deduction from 40,000 rupees all the way up to 1,25,000 rupees. But these three are largely in for something which is an expense, in the nature of an expense for an individual, right? Next is 80GG. So in case if an individual's salary doesn't have component of HRA, but you are still you're paying rent in the accommodation where you are staying, then because there shouldn't be any disadvantage to the person, because the employer has not provided HRA in the breakup. There is the section 80GG, so you can avail the benefit of section 80GG in place of in lieu of HRA. And the conditions which are applicable for HRA, the three conditions and lowest of the three, the same conditions again will get applicable here. So it will be a conditional amount of deduction which you will be eligible for. 80GGC. So there was a question about donation towards a political party or electoral trust in one of the questions which we received. In our view, it shouldn't be a risk. So the question was, is there any risk in doing so? So financially, there shouldn't be any risk because it is allowed by the law. it has to be given in a non-cash form. There is no cap on it. So very nicely, the lawmakers have ensured that there is an advantage for themselves, and you can give any amount of donation. There is the cap will be to the extent of your income. So if your income is 100 and you are donating 120, it will not happen that you will get 20 rupees to be carried forward as a loss next year. The deduction amount will be capped at 100 rupees in that example. But otherwise, you can donate any amount. There is no cap towards a donation to political party. Then section 24 is interest on home loan. So under 80C, what can be taken advantage of is the principal component of the home loan, whereas under section 24, you can take advantage and claim as a deduction the interest component which you are paying for your home loan. If it is a self-occupied property, then there is a cap of 2 lakh rupees. If it is a let out property, then there is no cap. You can claim any amount. Then 10.5 and 10.13a. So section 10 lists down a lot of exemptions. So there are total 50 subsections under section 10, and then various clauses or provisions and so on and so forth. All are not again widely used or widely applicable to a lot of people, but 10.5 and 10.13a are pretty widely used or pretty widely applicable to a lot of people, especially salaried individuals. So 10.5 is leave travel concession, and 10.13a is house rent allowance. Again, as I mentioned earlier, in house rent allowance, it will be a conditional amount which will be allowed. For leave travel concession, you will get the deduction only for the travel fare. So if you're traveling from place A to place B, either by rail or by air, you will get the deduction only of that travel. For lodging or any other expenses, local traveling, those expenses are not allowed as deduction. It will be only the rail fare or the air fare. So what we spoke about is the deductions under the old regime. In the new regime, most of the deductions have been disallowed. Only a few are allowed. So first and foremost is the standard deduction from your salary income up to 50,000 rupees. This is straight away standard. Then there is employer's contribution to notified pension amount account. So there, but however, there is a limit here of 10% of your salary. So this is allowed, but with a limit. And there are these allowances which may or may not make a significant significantly large amount when you sit to calculate your taxes. So in that sense, standard deduction remains a key deduction in the new tax regime. However, for somebody having income up to 7 lakh rupees, for them in the new tax regime, the rebate benefit of tax rebate is available. So if you have income up to 7 lakh rupees, then you don't have any tax liability. Now this may not be applicable for a lot of salaried individuals, younger people, because the incomes might be going beyond 7 lakhs. But at least, for planning out, say for parents and all, these criteria or the conditions can be kept in mind. So to summarize, the key differences between both the regimes. Under the old regime, a lot of deductions, exemptions are available, continue to be available. Whereas in the new tax regime, it is much more simpler. Right? So very few deductions are available, uh, and it's pretty clear. In the old tax regime, since a lot of deductions are available, you are in a way forced to invest or spend accordingly to get advantage or to avail those benefits. Whereas in the new tax regime, since it very few deductions are available, the investment criteria changes completely, right? You can invest on merit, on with complete freedom. You are not tied to put money in a long lock-in period like PPF or a Sukanya Samriddhi, so on and so forth. In the old tax regime, the tax rates are higher, right? The total taxable income reduces because more deductions are available, but then that income is taxed at higher rates. Whereas in the new tax regime, what people answered in the poll, the total taxable income is higher, but the rates are lower, right? So these are the advantages. New tax regime in that sense is much more simpler. It gives you a lot more freedom to invest or spend your money as per your will, right? Rather than parking money in those instruments, say in LI, in insurance, in PPF, in ELSS, wherever. You need not park in those. You need not think only about those options. You can just park, invest as you wish, or you can spend as you wish. So a checklist for filing the returns. First and foremost, know what is your residential status. Most of the cases it should be resident and ordinarily, so should not be a big issue. However, if you've been traveling, so there are certain criteria which your tax consultant will be able to explain you in much more detail. So if you stayed, a very simple one is if you have stayed outside of India for more than 180 days for certain reasons, then you become NRI. So something like that. So check your residential status, because then that will have a bearing on everything. So if you are a resident Indian, then it becomes much simpler. Make a list of different streams of income. Many times what happens is the focus might be only on the salary income, because that is something which you are tracking every month. You know the amount. At the end of the year, your HR will be giving you a form 16. So there you can see, but you might miss out on other streams of income, like say some dividend income if you have investments in shares, or in interest income if you have any investments in FDs, interest income from your savings bank account, so on so forth. So make a list of different streams of income which you are earning, which is hitting your bank account. Keep all these documents like bank account statements, interest certificates, FDs, TDS certificates, your Form 16, all these things ready. Apart from these, what you can do is you should log on to the income tax portal and pull out something called Annual Information Statement, or AIS. AIS is increasingly capturing more and more of the financial data, which is routed through different intermediaries, be it banks, be it mutual funds, or the RTAs like CAMS and K FinTech, and be it your broker, right? So capital gains, any listed instrument, not just shares, even if there are debentures which you have invested in, and there are some transactions during the year, or any transactions for your mutual funds, any FDs which you would have invested in, and you are getting interest, and there is some TDS deducted on that. All these kind of transactions are getting captured in the AIS, and on the basis of that AIS, your income, your return is pre-filled to the extent possible. So when you do that exercise, you'll see your income would be pre-filled to certain extent. Obviously, if there are any errors, any information gap, you need to clarify, you need to fill that, and that's not a very difficult process. In addition to that, so AIS is a fairly new thing. There is something called Statement of Form 26 AS, which was recording all the TDS transactions. So any tax deducted, be it by your employer or on your FDs, or even incomes like interest on income tax refund for the previous year, all those kind of things were getting recorded in this 26 AS. So 26 AS still continues. So there is some overlap between 26 AS and AIS, but going ahead, I think 26 AS will sort of lose relevance as AIS framework gets more and more better, more robust. So AIS is something very useful and critical, which you should check for yourself. Apart from these documents, so just couple of more slides for the presentation before I'll move to the questions. So here is a quick comparison on ATC, which is applicable for the old tax regime, right? So the most famous options for making investments under ATC are ELSS or tax saving FDs, PPF, EPF, NPS, so on and so forth. Tuition fee for children is not an investment; it is expense in nature, but that also is allowed under the limit of 1,50,000. Here, in our view, there are certain benefits of some instruments, certain disadvantages. So if you see equity linked savings scheme for somebody who already has exposure to equity instruments or has the risk profile to take exposure to equity instruments, bear the volatility, ELSS is a decent option or good option because the lock-in there is the lowest. So if you see the second column, the lock-in or the holding minimum holding period where you cannot withdraw, you cannot sell out, is the lowest for ELSS at 3 years. In PPF, the it is very long at 15 years. However, after 4 or 5 year period since inception, you can withdraw, but then there is some process, and the withdrawal again is capped. Right? Otherwise, it has the highest, the longest lock-in period of 15 years, and at it is predominantly of a debt nature, right? So your rate of return on PPF is fixed. It is determined by the government. However, the advantage in PPF is the interest which is earned is tax free. So if you, as you see in the last column, in case of ELSS, the gains which is earned on that ELSS investment, as and when in future you would sell or redeem those units, and whatever you are gaining, those that gain will be treated as your long-term capital gain and taxed at the rate of 10%. So in year zero, when you have made, or in year one, when you've made that investment in ELSS, you can claim up to 1,50,000 of the investment amount as deduction, and whatever gain on this 1,50,000, that will be taxed after year three. Whenever you sell in that year, it will be taxed at the rate of 10%. Whereas in case of PPF, EPF, NPS, ULIP, these are the gains also are tax free for NPS and ULIP with certain conditions. In case of the tuition fee, it is, as I said, it is simply an expense. So whatever tuition fee up to 2 children you are paying, you can claim with a cap of 1,50,000. So these are some of the links. We'll share, most probably share these with you. As you can see, it is all the links are of the official website. So there'll be a lot of content which will be available on the net. Sometimes the content may not be updated because the tax laws are changing, keep on changing. Not necessarily every year, but they keep on changing. So new tax regime is one change which we have seen in the last 2 years, right? Some of these links have tools again provided by the income tax authority itself. Third link, so which will help you to determine, or answer a lot of queries which you would be having. So this ends, brings me to end of the presentation. So there were certain questions which we had received. So what I'll do is I'll just quickly go through those questions as well, and after that we can take up questions of the people who are right now present on the webinar. Yeah. So there was a question on ATCCD. So I'm assuming the person wanted to know about ATCCD 1B, which is the pension, additional pension. So we have discussed this. There is an additional pension deduction available up to 50,000 rupees per year, and that gets invested into your pension account. This pension again has a very long gestation or long lock-in to say. You will be able to withdraw it at the age of 60, and that age also you will be able to withdraw 60% of the corpus. Then 40% has to be used to purchase annuities, which will then keep giving you monthly pension income. So that is somewhat of a complication, which I will say. But if somebody is fine contributing and staying put, so this kind of helps you to be disciplined, forcefully, so you cannot withdraw, and the money keeps on compounding in that sense. There was a question which mentioned that for salaried professional, please give tips. So uh, I mean, this itself, I mean, there was no further information which was available in the question. So what I'll say is, see, you should refer to the table of uh, deductions, the break-even deduction amount, which is there in our presentation. If you have deductions which are less than that amount, then you should go for the new regime. In case you are planning to take a home loan or an education loan, and the EMI on that, or the interest amount and the principal repayment on those loans, coupled with the investments under ATC of 1,50,000 and 50,000 of additional NPS, and 25,000 to 1 lakh of the Mediclaim, if all these are able to take the deduction amount over and above the threshold, then you can wait. Then you can continue being in the old tax regime, because you know that your deductions are going to increase and they'll cross the threshold. In that scenario, the old tax regime will be beneficial for you. However, in case you are very clear that your deduction amount will not increase the threshold, then you should switch to the new tax regime. Then there was a question on effective tax deduction for housing loan. So we've discussed, but I'll just quickly recap here. So in a housing loan, there are three, four benefits which are available. And the question was specifically for a plot, purchase of plot. So in case of a purchase of plot, and you've taken a loan for that, uh, there is one condition, that the plot should have been purchased for construction of a residential house for your use. That is a condition, when only then can you get benefit or deduction of this. So the same benefits are available under section 24, under section 80. Uh, Only thing is, you need to just be clear that you should be able to prove it, in case the assessing officer may raise an issue that he would want to know what is the end usage of the plot. Then there was a question by one of the attendees here, Divij. Ideal tax saving breakup, investment, insurance, etc., for salary bracket between 30 to 50 LPA. So again, one thing is, you should refer to the slide. I'll just present it for benefit once again. First and foremost, check what are your deductions currently. If they are less than this threshold, then new tax regime will be better. Then there is no point of investments or say insurance or anything else to take advantage for the tax, right? That is one. Second, as I mentioned, in case your current deduction amount is less than this, but you are sure, that there will be certain events like a home loan or education loan or something, or god forbid, if you are end up you end up incurring expenditure for medical treatment. So clubbing all these, if you know that in the near future your eligible deduction value will cross these thresholds, then you should continue with the old tax regime. So now in old tax regime, you need to take a call that what investments to choose, what insurance to go about. So typically, see what happens is, in insurance, in case of insurance, right, or in general, right, making any investments, tax should never be the primary objective, or tax saving rather should never be the primary objective, right? Don't make any investment or don't take an insurance plan with the primary objective that, okay, I will save tax on this. No, every instrument has its own purpose. Tax is a consequence, right? You are working not to save tax or not to pay tax. You're working to earn because it's your passion or whatever. Tax is a consequence of your activity of working. Similarly, tax is a consequence of any financial decision that you are taking. So based on your risk profile, I think I will put it that way, that based on your risk profile, you should go for any of these instruments. So if your risk profile is say of growth in nature, then you can look at ELSS. Otherwise, a lot of the options which are available are predominantly of debt in nature, whether it is tax saving FDs with a 5-year lock-in, PPF with a 15-year lock-in. EPF again predominantly would be investing in debt-oriented instruments. NPS is a mixture, but again with age, the orientation will keep on changing towards debt. So based on your risk profile, I would suggest that keep that in mind when you are investing, and look at the returns, look at the lock-in period, what is the nature of the consequent income, right? Which is say tax free in case of PPF, the interest earned on PPF, whereas for ELSS it is taxable, the gain on the investment. So those things should be kept in mind for investments. When it comes to insurance, uh, term plan ideally is the best, right? It solves the purpose of life insurance, ensuring life of the breadwinner or the key earning member of the family. It is the most efficient instrument. So again, what I'll say is, don't look at tax saving as a primary objective. What is the role or objective of that instrument, whether it is investment or insurance? So when it comes to insurance, in life insurance, term plan is better because the cover which you get, or the ratio of premium cover, the term cover to premium is very high compared to an insurance plan where investment is also mixed, right? So I would put it that way. You can also then look at the options like NPS, where you'll get additional benefit of 50,000 rupees apart from 1,50,000 rupees. There was a question: is ELSS and PPF all comes under ATC exception? So yes, ELSS, PPF, all the other instruments which we saw, all these put together have a cap of 1,50,000 rupees. Each on its own doesn't have that cap. So if you have, say, you have made a contribution to PPF in this year of say 80,000 rupees, uh, the remaining availability is just 70,000 rupees, right? So after that 80,000 rupees of PPF, if you were to invest 1 lakh rupees in ELSS, still your deduction will be capped at 1,50,000 rupees. It will not go beyond that. However, on the other side, if all these investments combined, you have spent or invested, say 1,40,000 rupees, then the deduction which you can claim in your return will be capped at 1,40,000 rupees, not 1,50,000 rupees. How to fill ITR was one question. So see, this is something which which will be difficult to show on a webinar. Uh, However, there are two methods. One is online. You log into the portal. So again, the link is provided in that slide to that specific portal where you need to log in, and you can fill it online. And when you input certain data, as I mentioned, from your annual information statement, certain data is pre-filled, right? The second is you download an Excel file or Excel utility, you fill it there, and there is some technicality. You have to generate a JSON file and then upload that JSON file on the portal. So my suggestion here would be that if you are not very familiar, if you are filing the return for the first time, just think, what will be worth? Will it be worth to spend all that time, or will it be worth paying some fee toward practicing chartered account or a tax expert and get it done from them? Slowly, as you get familiar with it, you can take a call, in a few years time, what you want to do. Would you want to continue with the CA, or you would want to do it on your own? uh, Few things you can keep in mind, which are recent also. If you have invested into any virtual digital asset, right? Be it NFT, crypto, you will have to report that from this year. So starting this year, so there is a schedule or a section in the income tax return dedicated to VDA, virtual digital asset. It doesn't say crypto. So my assumption is, whatever it is, if you are having, you'll have to just report that, right? That is one. Second, if you own shares of any unlisted company, then that also needs to be reported in the income tax return. So just keep these things in mind, because these are relatively newer things, and unnecessarily, your intention may not be to hide, but in case you miss it, it can just create some issues in future. So whether you've purchased shares of unlisted company during the year, or you've been owning them from say previous year, and you continued owning at the beginning of the year and you sold it, in any of these scenarios, where if you were owning it for any part during the year, you need to disclose that in the return. Um, Then, so some of the questions were, like asked differently, but the answer for all those questions will be the slide which gives the threshold or the cutoff of the deduction amounts. So this becomes like a key slide for you guys to decide between the old and the new tax regimes. Uh, would like to know about deduction available for self-employed professionals, SMEs. So, see, how it will happen is if you are running a business or like a professional activity, apart from deductions or before deductions, any expense, legitimate expense incurred to run that business, professional activity, or earn that income is allowed as a deduction, right? So you have your revenue, you have all the expenses, legitimate expenses which are incurred to earn that income. You can deduct that, you arrive at the PBT, and then these deductions begin. Apart from that, if especially if it's a new company, then you can take advantage of the new tax rates which were introduced in 2019, right? So in case a corporate entity decides to forego all the deductions, then they can take advantage of the lower tax rate. So this is strictly for the corporate entities only, not individual assessees. So the lower tax rate will be at 25.17%. So if you see a lot of companies, the large listed companies on the stock exchanges, their tax rates also in last few years would have moved down, say from 33% or 30% plus to 25.2%, because they have availed the benefit of this change, which came about in 2019 after the general elections that year, wherein the government allowed that if the corporate assessee is ready to forego the benefit of all deductions, then they can avail of this lower tax rate. And in spirit, that is what they have done with the old tax regime and new tax regime. So first they brought this change optional thing for corporate assessees, and after a few years they brought the similar thing for individual assessees as well, right? uh, So there was a question on how to use HUF as a tool for taxation and investments. So what I said for investments, insurance policies, right? That tax should not be the primary objective for any activity, right? Tax saving rather. So same thing for HUF, I will say it is completely legal. It is completely allowed. But are you doing or are you creating a HUF PAN card fully to split the income? If that is the case, fine, you will be allowed. There may be scrutiny because there is a possibility that the assessing officer might think about it or view it suspiciously, not 100%, but possibility one. Second, it brings its own set of complications with it, right? Which is the assets of the HUF are co-owned by all the members of the HUF. So if there is some issue between the members and there is a demand for divisibility or partitioning the HUF, then that can bring its own set of complications. So that's why my suggestion would be, again, don't think of HUF as a prime, like from the primary objective of tax saving. It is legitimate, it is allowed for sure. Um, there was a question on section 10, section 54, section 57. So section 10, as I mentioned during the presentation, is very, very vast. And there are many subsections which are very specific, say to geography or types of income, like agri income, right? And 210, subsection 5 of section 10, which is LTC, and 13A, subsection 13A, which is HRA, I spoke about. Section 54. Now, this relates to deduction available when you have sold capital asset, which is most probably a property, right? So there is section 54, then there is, I think, 54B, 54 EC, 54 Fs, so on and so forth. So the rationale or the logic behind this was, and especially in case of a house property. So suppose there is an assessee who has, say, a 2 BHK, now wishes to sell it and buy a bigger house because family has grown bigger, right? So when you sell your old house, it is a and especially and like if it's a long term capital asset, so it is subject to taxation, right? But here the intent was not to profit. It was a self occupied property where the assessee was living. He or she is selling it and is planning to buy a new house. So it was bringing unnecessary burden of taxation on the capital gains when you are selling the house. So to give benefit and not to unduly burden the assessee, there is a benefit or deduction available in section 54, which says that when you are selling a property and then subsequently 1 year before the date of selling and 2 years after the date of selling, so in that window of 3 years, if you have or if you will buy another property, which is a house self occupied, then there is a deduction available with a cap. So whatever gain, so if when you sold the house, your first house, the gain was say 10 lakh rupees. You bought a new house for 20 lakh rupees. So because the amount is bigger than the gain, the entire gain in this example is exempt from tax, right? You get deduction. There is no tax. If you bought new house for 8 lakh rupees, then in this example, 2 lakh rupees will be charged to tax, right? So this is simply like in a nutshell the premise of section 54. In the links which will share, the last link pertains to a summary of 54 and some of the subsections of section 54. It is a booklet by income tax department which summarizes what kind of assets when they are sold are eligible for 54 and what kind of assets should be bought in what time frame, so on and so forth, right? Section 57 pertains mainly to income from other sources. So you have specific heads of income, right? Salary income, income from business or profession, income from house property, income from capital gains, so on and so forth. Wherever for any income which doesn't fall into any of these specified sections, there is a general section, income from other sources. It contains interest income, dividend income, income from winning lottery, horse races, and many others. So here again, a generic kind of deduction which is available is that any expense legitimate which is incurred to earn that income will be allowed as a deduction. So a recent change here has happened in case of dividends. Dividends till some time back were not taxed. Right? The company used to pay the tax on it when they would declare dividends. Individuals were not liable to pay tax, but that changed. Now it falls into the income from other source bucket, and it is taxed at my marginal rate of tax. Right? The highest rate of tax, which is which I have to pay tax at. So here what the provision says that if you have taken a loan to invest in shares and then on that investment you are earning dividend income, then you are incurring interest cost on that loan, right? Which you have used to earn this dividend income indirectly. So with a cap of 20% of the dividend income you can claim. So if your dividend income is 100 and your interest, whatever interest you would have paid, if that is more than 20%, so if that is more than 20 rupees, then up to 20 rupees you can take a deduction from the dividend income. So the taxable dividend income in this example will become 80 rupees. So that was on section 57. uh, there was one last question, two last actually. How can we save taxes by starting small company along with our day job? So uh, I'm assuming here that you have a business idea. I hope this was, I felt a little bit interesting. So I'm assuming here that there is a business idea which you plan to start up with. So if that is the case, then as I mentioned earlier, that whatever expenses you will be incurring for the business, those will be allowed as a deduction. Even before starting the business, there are certain preliminary expenses which an entity or a person has to incur. Like say, if you have to get some permission or some license from any regulator, so those are called preliminary or pre-operative expenses. Even those are allowed as deductible expenses, even though you incurred those before the business started. right? Because they are important. They are key to start the business itself. So any expenses which you incur are allowed, and then just if it's a corporate entity, then all your usual taxation laws will be applicable to you, so you can take benefit of the deductions. If you opt for the new regime for the corporates, then you can take advantage of the lower rate of tax. However, if you are asking, I mean, if the question is that there is no real business or there is no income, and you are floating a company just to take some tax benefit or benefit of the costs, then it's not very clear whether because there has to be some income. You cannot show individual income, form a company and take some spends on those in that company, on that entity, and club those two. No, they both, in the eyes of law or in the eyes of income tax authority, are separate individual or separate persons. So individual is a individual, the corporate entity is an artificial person. So you cannot simply just club both of them and take advantage in that sense. The last question someone asked is want to know in detail about dependent parents claim in income tax. So not very sure how, if this pertains that you have dependent parents and you are incurring any medical expenditure for their well-being, then you should explore section 80D, 80 double D, and 80 double DB. So 80D, if you are paying premium for your dependent parents, 80 double D for handicapped dependent, and 80 double DB for medical expenditure on self or dependent relatives, for diseases which are specified in Rule 11 double D. So if that was the question, then you should explore these three sections. If you are incurring any of these expenditures, then you should take advantage of those. So here, largely all the questions which we had received before the webinar are most of them have been answered. If the participants here who are here right now, they have any further questions, please feel free to ask. We would be more than happy to answer you. Kirtana, can they simply ask, or you will have to unmute them?
Um, yes, Karthik. So I will have to unmute them. So whoever wants to ask any question, please just raise their hand so I can unmute them.
Okay, so there are some questions here. I have not seen them. I'll just take one by one. What if the education loan started in 2015 and closed in 2019? Can
Karthik,
the
I've answered the queries on the
okay,
chat.
okay, cool.
Yeah, all of them. You
Okay,
can read if you want, but yeah.
fine. Uh, Shivam, you have mentioned, can you go back in slide once? So any particular slide number which you want to have a look?
I have unmuted Shiva.
Shivam?
Yeah, the doubt is clear now. Thank you. It was slide number 17.
Okay. Okay. Thanks.
Meanwhile, I have shared a link for all the feedbacks, link for feedbacks. Please share your valuable feedback so that we can provide good and valuable webinars to you for you guys in the future. Uh, if you have any queries, you can put it on that feedback form also. We'll wait for another 2 minutes.
Sure. Uh, so I'm just looking at the questions again. There was a question from Aishwarya, how to manage for online food business. Aishwarya, anything specific which you are looking for here? Uh, because I mean, any specific deductions which might be available for online business or a food business, or how exactly you are looking for?
I have unmuted Aishwarya.
Am I audible?
Yeah, yes.
Okay, sir. The basically, I'm starting my food business on online food business. So for that, I'm searching for the tax and deductions.
Okay. So see, there won't be specific deductions for each and every kind of business. Okay, that is one. Second, so one, it will depend on the kind of like what's the nature of the business, right? So there are sections 80IA to 80IE, which are specific, like which are there for some specific kinds of businesses, but those will be few and far between. Here, what I'll suggest is whatever spends you are incurring, okay, for the business, you keep a clear account of that, separate account, invoices, bills. Basically, you should be able to prove to the assessing officer if it comes to that, right? So I'll tell you, I'll give you my example. I remember it very vividly. When I was studying, my professor, how he explained to me, and this was, I think, some real case study, that there was a gentleman who had a business of manufacturing and selling soap. Okay. His wife was also part or employee of the organization, and she was some head of marketing or something like that. And her degree was completely, different compared to that. So there was a doubt that is this just to show employee expenditure and take advantage of that, reduce your taxable income and pay less tax. So what simple practical test the assessing officer did was that here is a bar of soap. How will you sell it? If you are the head of marketing, you should have that skill. How will you sell it? That's it. So the point is that whatever spends you are incurring for that business. So I'm just assuming, again, this is an example, right? If say you are incurring, you're running it out of your house, so you are using the gas connection which you will use even for your personal use. So what you can do is you can apportion. You assume what how much gas, which is a rough estimate, is getting consumed for your business, and how much of the consumption is for your personal usage. So whatever is the bill amount, so if say it is 50/50, so half the bill amount you can claim as a deduction in your business. The test will be you should be able to prove that this is a legitimate expense which I have incurred to run my business, to earn the income from that business. If you can convince it, all those expenditures are allowed. But if there are any specific, so there can be startup related expenditure if it's a corporate entity. So for those specific or nuanced deductions or benefits, I'll suggest that you should take help from a practicing chartered accountant, a tax expert who is well versed, whose day in day out job is to work with these things. That will be the best way to go about it.
Okay, sir. So from the starting, I should go with GST, or after certain sale, I should go with GST number.
No, GST need not take right away. So there will be a threshold in terms of the revenue. So unless you cross that threshold, you need not take it.
How
Only
much?
I'll also, so GST is again becomes part of the indirect sorry, indirect tax. So even I'll have to check what is the threshold for GST. The again here, simply just don't think that way. Again, see how, whether even if you are not crossing the threshold, would it be beneficial for you to take a GST registration today to claim the GST input credit? So again, here, if you can sit with a tax expert with the numbers of the business, right? Whatever is the revenue, what are the expenditures, then doing calculations with those real numbers, you'll be able to take a much more fine-tuned decision whether to go for it. So usually a lot of people avoid the registration, but that can have ramifications or they can have repercussions on the GST input tax credit, which you will not be probably able to avail of.
Okay, for that purpose, I should recommend a CA, right?
Yeah, you should check with the CA. Yes.
Okay, so he will guide me properly. That's what you are saying, right?
Yes.
Okay. Thank you.
Sure. Kirtana, shall we close?
Thank you everyone for attending the webinar. I hope you all have shared your feedbacks in the feedback form.
Ma'am, sorry for the interruption, but I had consulted one CA and he was like, कि, after crossing 20 lakh revenue, you must go with the GST number.
Yeah. So that time, so it will become mandatory for you. You'll
Because
have.
my business is regarding, I am having a Zomato and a Swiggy online business. Okay, so we are presently running a cloud kitchen model. Okay, so for that purpose, I was having a consultation from your side.
Right.
Thank you everyone for attending the webinar. I hope the doubts are cleared. If there are any doubts, kindly put it on the feedback form. We will definitely answer them. Thank you everyone. I would like to close the webinar now. Thank you. Have a nice
Thank
day.
you, everybody. Bye-bye.
Bye.